Hey friends, you don't need fancy degrees, a high IQ, or sheer luck to be successful in investing. All you need is some basic knowledge of investing, a solid investment strategy, and the ability to control your emotions. And if you can master these, you can easily make great profits from the stock market. Now, let me be honest, The Intelligent Investor can be a bit boring to read, but it's considered the Bible of the investing world because every single page is packed with timeless investing wisdom. I've read this book many times, and in fact, Warren Buffett, who is currently the fourth richest person in the world, has built his entire wealth through the knowledge of investing. So today in this video, I'm bringing you 4 powerful investing lessons from this book that will greatly improve your investing knowledge and help you make better investment decisions. But before we get started, I'd love it if you could subscribe to this channel, Finlit Finance, and press the bell icon so that you never miss out on any videos related to investing and mindset. Lesson number 1, the investor and market fluctuations. One of the biggest problems people face with the stock market is the constant fluctuations. So to overcome the fear of these market swings, let me teach you a simple yet powerful lesson from this book. Imagine you started a business with a few of your friends. You invested $1,000 in this business, and each of your other 4 friends also invested $1,000, making it a total of $5,000. Now imagine one day you're sitting there calmly sipping tea, when your friend approaches you and offers to buy out your partnership or sell you more shares. Who's a bit unpredictable? Sometimes he quotes a ridiculously high price, which seems too good to be true, and other times he quotes a super low price, making you think he's lost his mind. The price seems completely unreasonable. This partner is Mr. Market. When Mr. Market is excited, he might quote a high price, maybe even valuing your $1,000 investment at $100,000. On that day, you might consider selling. But on a day when he's fearful, he might quote a low price, maybe $500. That's the day you might consider buying. So if you're smart, you will buy more shares when he's panicking and selling at a low price, and sell your shares when he's overly optimistic and quoting a high price. But most of the time, your best strategy is to simply ignore his daily price quotes. Because back in the day, Mr. Market would only quote prices through the newspaper maybe once a day. But today, he's become way more impatient, changing prices every second. That's why Benjamin Graham's logic is more applicable now than ever. The most important lesson here is that price and value are 2 different things. Sometimes there's a huge gap between them because price is what you pay and value is what you get. You should only focus on price when it's in your favor during transactions. Otherwise, ignore it and focus on the actual value of the business. Lesson number 2, investment vs. speculation. Many people assume that just buying stocks makes them an investor, even if they haven't done any research. That's why most people end up losing money in the stock market. When they profit from speculation, they become overconfident and invest more until they learn a costly lesson. According to Benjamin Graham, real investing means conducting thorough analysis. This involves understanding the quality of the business, the strength of its management, and its valuation. I'll make a detailed video on these aspects, so don't forget to subscribe to the channel and press the bell icon so you don't miss out. The second most important point is the safety of principle. If you ask someone why they don't invest in stocks, they'll often say it's too risky. My money isn't safe. Benjamin Graham's rule is to only invest when you can ensure the safety of your principal amount. Profit is secondary, your capital preservation is key. Lesson number 3, criteria for selecting stocks. Adequate size of an enterprise. Focus on large companies because smaller ones are usually riskier. Strong financial condition. The company's current assets should be at least twice its current liabilities, meaning a 2:1 current ratio. Additionally, the company's total assets should exceed its total debt. Earnings stability. The company should have consistent profits over the past 10 years. Dividend record. It should have a history of uninterrupted dividend payments for at least 20 years. Earnings growth. The company's profit should have grown by at least 33% in the last decade. But in my opinion, the company's profit should at least have doubled. Moderate P ratio. Also, the stock's current price shouldn't exceed 15 times the average earnings of the last 3 years. Otherwise, you're overpaying. Defensive investors should avoid stocks in the growth stock category. Lesson number 4, margin of safety. Once you've researched and found the best company, pay close attention to its price. Don't buy it at a premium. The margin of safety teaches us that you should only buy stocks when they're significantly undervalued. For example, if an engineer is building a bridge that needs to support trucks weighing 20,000 lbs, he should build it to support at least 30,000 to 40,000 lbs to ensure safety. Similarly, if a stock's intrinsic value is $100 per share, aim to buy it at $66 or lower. This way, if your estimates are off, the margin of safety will protect you. When you follow all these rules, ignoring market fluctuations, focusing on business research instead of stock prices, and maintaining a margin of safety, you might still encounter some losses. But overall, if you build a well-researched portfolio of 10 to 15 stocks, you're likely to see great long-term returns. That's all for today's video. If you learned something valuable, please subscribe to this channel and support me. Share this video with your friends and family so they can also learn what investing is truly about. And let me know in the comments what topic you'd like me to cover next. If you like this video, give it a thumbs up. If not, give it a thumbs down. Thank you for watching, and I'll see you in the next one.